First off, good morning, good afternoon, everybody. Welcome to our discussion on housing investments in the new normal, or as many might say, the new abnormal. My name is Ryan McBride. I'm the Chief Operating Officer of CoreVest Finance, and I'm going to be your moderator today. This is the second digital version of our Investor PopUp Series, which is co-sponsored by CoreVest and SFR Hub. And it's a series that highlights the relevant topics for residential real estate investors and helps us to connect people in the space. Normally, we host these in-person gatherings across the US in various markets, but for obvious reasons, we're not doing that today, and we're doing it on Zoom. The last webinar we discussed was great. It was about build to rent, which, as many of you know, is the shiny metal in the space that many people are attracted to, and I would guess that we're going to touch on some of those themes later on today. But this topic, housing investments in the new normal, was actually picked by those of you in the audience that participated last time based on your suggestions after our last event. So thank you for that. We do listen to you. Accordingly, we assembled a great group for you today. You can see by the screens on Zoom. These are actual operators in the space spending money, putting money where their mouth is, if you will, in terms of the strategies they're affecting. And there's those of us that are supporting them through our research, our transaction services, and our fundings. So with that, just a couple things on the format for today. It's going to be a reasonably free flow conversation with the experts. First off, we're going to do a quick round of panelist introductions. Next, we're very lucky to have Daren Blomquist from auction.com with us, and he's going to spend a few minutes going through what he sees in the markets and sharing some interesting facts and figures with us, so don't miss that. Afterwards, we're going to spend a few minutes with each of the panelists as they walk us through what they think are the interesting themes and opportunities today. And then the balance of the webinar is really going to be answering questions that have been submitted by you in the audience, so thank you for that. If you haven't submitted questions yet, or something comes to you as we're talking, use the tricky Zoom feature and submit it to us, and we'll do our best to get to them as soon as we can. And then finally, throughout the discussion, we're going to be doing survey questions, so keep an eye out for those. Those are kind of fun to do, and we'll be broadcasting the results real time as we do this. So let's get to it. I'll do a mercifully quick intro, and then I'll hand it off to the rest of the panelists here. As I mentioned earlier, I'm Ryan McBride at CoreVest Finance, where I'm the Chief Operating Officer. We're a nationally based lender focused exclusively on residential real estate investors. We've been doing this since 2014, done a little over 10 billion in investor loans in that time frame. We finance a wide range of property types, from single family to condos to townhomes to multifamily to mixed use, just about anything that you're thinking about doing. And really two main product buckets. Our rental loans, which are typically 5 or 10-year fixed rate term loans. And then we also have our bridge lending program, which are shorter duration loans, 12 to 24 months, and are really used for acquiring assets, aggregating assets, for construction financing, or to rehab existing housing stock. So with that, I'm going to turn it over to Mr. Michael Finch at SFR Hub and let him introduce himself.
Thank you, Ryan, and everybody else here for participating. Michael Finch here, principal founder of SVN, SFR Hub Advisors, and the SFR Hub companies. We do a variety of things here, from full service brokerage in the single family investment arena, portfolio arena, and the build for rent space as well. We also own SFRHub.com. That's a data and valuation and digital transaction site. We do a lot of third-party consulting out of there with developers and builders in the build for rent space, as well as some fee-based consulting for groups looking to value their portfolio, and that powers our brokerage across the country as well. We also have a company we're launching in 2021 called SFR Hub Modular, selling new home building systems to the build for rent space to developers and builders. We can assist in some debt and equity introductions as well, obviously with CoreVest here. And with McIntyre Capital, we can help developers and builders source equity if they need it. And we also have a large capital fund where we're acquiring aggregating and stabilizing built-for-rent communities around the country. About $1 billion acquisition fund that's just launched. So yeah, all these companies are really circularly integrated to the benefit of clients, and there isn't much that we can't do to help. So look forward to the discussion and seeing where we can help any of you on the line here.
Great, thanks, Michael. Why don't we skip to Bruce McNeilage at Kinlock Partners?
Thank you. My name is Bruce McNeilage. I'm the president and co-founder of Kinlock Partners out of Nashville. Most of the business we do is in the Nashville and also Atlanta, and then throughout South Carolina. I started doing build to rent in 2005. And of course, fast forward to today, it's become probably one of the more popular, if not in the home building, the most popular thing right now that people are talking about. I'm looking forward to talking about things today and giving my perspective.
Great, thanks, Bruce. Mike McMullen from Prominence, love to hear from you.
Yeah, thanks, Ron. I'm Mike McMullen. I'm in Birmingham, Alabama, and I'm the CEO and one of the owners of Prominence Homes. We'll build about 600 houses, 85% of those for build to rent this year. We also own Alabama Rental Managers, soon to be America's Rental Managers, that manage about 1,700 properties right now. And we're in 6 markets at this point: Huntsville, Tuscaloosa, Birmingham, Jackson, Mississippi, Memphis, Southern Mississippi, and Baldwin County, Alabama. And then we have a team that sells about 1,100 units a year. So we do mainly investment property sales. So look forward to hearing the questions.
Great, thanks, Mike. Doug Skipworth, would you like to go next?
Yeah, hey, my name is Douglas Skipworth with Crestcore Realty in Memphis, Tennessee. A little bit like Mike, we own and manage and help others buy. So we've got probably a portfolio of about 1,000 we own, and then we manage another 2,000 properties, mostly single family homes and small apartment complexes for probably about 750, 1,000, mostly individual investors from all over the world, buying and managing in Memphis. And then we probably do maybe 350 to 500 investment sides a year through our brokerage. So glad to be here.
Terrific. Glad that you're here with us. Jared, do you want to go next?
Sure. Good morning, everybody. My name is Jared Vidalis. I'm the co-founder of Equity Connect Holdings. We're located out here in Scottsdale, Arizona. We operate in both the Phoenix and Vegas MSAs. Our niche, acquiring residential assets significantly under market through a direct to homeowner acquisition strategy. Strategy is pretty simple. We renovate and hold the best assets in the best locations, and then we flip the rest on the retail market. Also, we just took down a few small to medium-sized parcels where we will be building rental product, just because it's becoming extremely inefficient with the way the market is now to acquire one-offs. And yeah, excited to talk to you guys today.
Great, thanks. Russell, do you want to go next?
Definitely. So my name is Russell Schmidt, and my company is Benson Residential. We're an acquisitions and advisory firm specializing in transacting on off-market bulk portfolios of SFRs on behalf of institutional capital, particularly institutional capital that has yet to enter the space but is eager to get in. My partners and I were previously at Amherst Residential, where we built out their direct-to-owner bulk portfolio sourcing effort, and recently made the decision to start our own company to provide these services to new capital looking to enter the space. We also own a couple and have a small fund of our own where we buy in a couple markets, but the main focus is sourcing, negotiating, and ongoing asset management on behalf of new funds looking to get in. So thanks to CoreVest and SVN for having me on. Looking forward to it.
Great to have you. And then last, but certainly not least, Daren Blomquist. Love to have you provide your intro, and then also I know you have a presentation that we plan to walk through for the next several minutes as well.
Yeah, absolutely. Thanks, Ryan. Great to be here with everybody. And I'm as excited to hear about kind of what's happening on the front lines. I get to view the data from a higher level a lot of times. So it's always good to hear from the frontline operators. But yeah, I'm Daren Blomquist. I'm Vice President of Market Economics with Auction.com. And we're a service that sells properties. We sell two types of properties: the foreclosure sales, foreclosure auctions that typically occur on the courthouse steps, as well as the bank-owned properties, which are available through online auctions. And I'll get into that a little bit more, but we sold over 50,000 properties through our platform last year. So the biggest source of the biggest player out there in terms of the foreclosure auctions and bank-owned online auctions in the marketplace. And I get to look at a lot of our data and see what's happening in trends with our buyers and sellers, as well as the larger marketplace. And so with that, I can jump into just a few slides I have. I think I actually have a full deck of probably 25 to 30 slides that I sent over to CoreVest, but they were like, no, we've got a lot of good insights on this panel, so we got to trim it down. And so just a few takeaways, but yeah, if you, Tuan, if you want to share those, then we can get started. Just a few key takeaways that hopefully address some of the questions that came in prior to the webinar on what's going on in the marketplace. And yes, there we go. So this is really an answer to the question of how the pandemic has impacted the single family rental market. And there was a lot of narratives early on, a lot of theorizing about how this could negatively impact the rental market a lot more because of the types of jobs that were being lost as a result of the pandemic. But what we're seeing, this is data from the Census Bureau. They put out a weekly survey. They've started putting out a weekly survey after the pandemic hit. And one of the questions they ask is around, are you current on your mortgage payments? Are you current on your rents? And what stands out to me here is on the left-hand side, there is a clear upward trend in the percentage of homeowners who are saying they are not current, not caught up on mortgage payments. Where on the left or the right-hand side with the rents, you don't see that kind of trend. Now the percentage is higher, hovering around 16%, but that has not, there was a little bit of a trend up, but it's actually come down in that. And so that's actually, I think, a surprise to many people that we haven't seen, and I've heard it on the ground. I'm sure many of these operators could say it, could echo this, that we haven't seen on the ground a big drop off in rents, in the percentage of delinquent rents or missed payments. So the next slide follows up on that. And actually this is data from CoreLogic, and there was another report that came out just yesterday on this, is we are seeing continued growth in this is specifically single family rents, up 1.7% in July. And the data that just came out yesterday, I believe it was over 2% in August. So we're continuing to see growth nationwide in rents that has slowed in both July and August. The rent growth has slowed relative to a year ago. And there are a few markets that are underperforming here that probably make sense in given all the trends that are happening post-pandemic declaration. We see Honolulu, Los Angeles, Miami, and Boston, more expensive, denser types of metros that are experiencing these declines in rents. But places like where Jared is in Phoenix, having very strong rental growth in 2020. It's still down a little bit from 2019, but very strong there in places like Arizona, North Carolina, where I believe Bruce operates quite a bit as well. So next slide, we'll get into a kind of a different question is, where is the inventory? And this is our own data of auction.com. And one misconception is because of the foreclosure moratorium, there are no foreclosure auctions happening. But what we are seeing is there's a gradual return of foreclosure auctions. This is almost exclusively on vacant or abandoned properties that are exempt from the moratorium. And you see the states, the green basically is where we're seeing more inventory return, whereas the blue is not. So you see a place like New York is 0% relative of foreclosure auctions happening in September of this year relative to a year ago. Whereas if you take a state like where Mike is in Alabama, that you see the inventory loosening up there at over a third of the inventory that we had a year ago. So it's still way down from a year ago, but we are starting to see some of that inventory return. And we do see about 60% of our buyers on our platform fix and flip, and about 30% are saying they're holding as rentals. So there's a mixture of strategies with our inventory. All right, next slide. This is a look at the fix and flip. This is data that I have access to through Atom Data Solutions, public record data looking at home flipping. And again, this was something early in the first couple of weeks after the pandemic hit, there was a lot of nervousness around how that would impact, especially home flippers and the types of what the market was going to look like, what that would do to home prices. But what we've seen on the left there with the green line is 2020, really that delta between purchase price and flipped price or resale price for the flipper. Right around when the pandemic hit, actually a little bit before, we started to see that separate from the 2019 numbers, and that's continued to separate. And so we're seeing that potential profit, I guess you call it, I hesitate to use the word profit because it doesn't include expenses, but that gap has widened in the last few weeks. And on the right-hand side, we see that represented as a percentage of the purchase price. That trend is not quite as clear, but still you see pretty much 2020 outperforming 2019 when it comes to returns or potential returns on home flips. All right, next slide. And then, yeah, the last two slides here, and I'll be happy to make my presentation available because there's several interactive heat maps that you can go in and look at your market. But the last two slides here are just looking at potential returns. This is specifically with home flipping by market. And so you see one thing that stands out to me here is where a lot of the green is here, which is the higher potential home flipping returns. You do see that serendipitously, I guess, is coinciding with the heat map on a couple slides earlier, where we are seeing some of the inventory return. So the inventory is returning in many of the markets where some of the best returns are available on home flipping. And again, I won't go through this in detail, but happy to make these available. The next slide shows a similar situation looking at potential returns on single family rentals. This is specifically through the prism of properties that were bought on our platform and the prices there. So those do tend to be below market prices, and then the returns that are potentially available given the fair market rents in each of those markets. So there you go, and happy to entertain questions later on about any of those slides, but that's some snippets of our view of the market.
Daren, thank you very much. That's helpful. I know that people will be eager to take a closer look at those slides. I think at a later point in time, I believe we're going to make those available. We have our first survey question, if you want to broadcast that. So I am a investor, broker, developer, property manager, other. All right. 70% of you are investors, which is probably a good thing for a webinar based on investing. So I think we're all lined up here. Okay, so what we're going to do now is just a quick round robin with the panel, just talking about investment opportunities that the group is seeing and that they're executing on, specifically. I got to tell you, from a lender's perspective, talking to, dozens of folks across the country over the last several months, it's amazing how quickly people went from pumping the brakes in the beginning of March, maybe into April, to assessing the market, seeing the strength in the housing market, seeing the trends developing, and then people going full bore into their strategies or making decisions to do different things. But we see quite a bit of activity. The last few months have just been unprecedented in terms of the amount of investing, the amount of activity levels that we're seeing, and obviously the housing market is on fire. So let's see what the panel thinks specifically. Bruce, I think we're going to start with you to see how things are going in your world.
Sure. So it's just tougher and tougher to get deals. The dirt, is more expensive. The development, certainly materials have shot up with lumber and whatnot. So it's really been difficult to build houses and do things that make sense. We've slowed down a little. The average lumber package on the house we're doing is up about $14,000. So that's made it difficult to do houses, and certainly it throws off your pro forma. So in our business, it's just made it tougher and tougher to get things to pencil.
Got it. Thanks. Mike, how about yourself? Mike McMullen.
Yeah, going back to what you were talking about, Ryan, in March, is we made a decision as a company the first week into the pandemic that we were listening to a lot of the construction companies around us, and everybody was pulling back 50%. And as you know from handling our loan portfolio, we made the decision to accelerate and increase our production 50%, which was a smart move at the time. We thought it was and felt like it was based on everything we were seeing. And by doing that, what it did was gave us more buying power with our suppliers and our subcontractors, where what Bruce was talking about with the increase in lumber packages, we're up about 7,800 per house on our lumber packages, but it's in the packages are coming down gradually, and our suppliers tell us that should level out by January once all the mills are producing like they should again. And so we're anticipating that should level back out by January.
Interesting. Got it. Thanks. Doug, how about you?
Yeah, obviously some of that, we're not really in the build to rent space, so we can't speak to what those guys did. Occupant, it kind of in contrast to what the national news or media would lead you to believe. We manage a bunch of property, and we've had a really strong 8 months. Occupancies are at record highs for us across all the portfolios we manage for. So collections are down slightly, but the occupancy has more than made up for the kind of collection issues. So that's been great for buy and hold investors who already had a portfolio in place. So the performance of the portfolios is great. Maintenance work orders are down low, so everybody's leasing. People are staying in places longer, signing long 2-year leases. So that's been really good for us. It's been a good time for people to prune their portfolio. It's a seller's market. So if you have some underperformers, the values you're able to get for those properties are again, at kind of record highs as far as we've been doing this. We've been managing properties for 20 years in our market. And we saw this in 2008 through the Great Recession, that the occupancy stayed good on rentals and the collection stayed good. People want to have a roof over their head with utilities. They're going to pay their transportation and they're going to pay their food. Everything else is discretionary, but those 4 items we have found both in the Great Recession and through the COVID pandemic. From a rental operator and investor perspective, it's been, I think that the single family market specifically has outperformed what anybody would have thought during this pandemic. So it's a great time to be an investor. It's a great time to refinance. If you haven't refinanced, I would bundle up portfolios. I saw a question about why would you use a national lender instead of a local bank. We used CoreVest, a national lender, when we got hit a ceiling with our local banks, we non-recourse it with CoreVest and then went back to the local banks. So anyway, a great time to be an investor. And the last thing I would add is because the market is such that there are not a lot of great opportunities, we've really focused inwardly about improving processes and just trying to prepare to get better and better and better, whether any kind of operational excellence that we could improve. So that's kind of our take from more owner, operator, manager perspective.
Got it. Thanks, Douglas. Jared, we're going to move on from the Southeast and talk to somebody who's doing something in Phoenix and Vegas. So what's going on in your world?
Oh, absolutely. So on the flip side, similar to what Mike experienced when COVID hit, we had a decision of, do we pull back, or do we take down all these properties that we just brought through the door? So, we bring in anywhere from 20 to 25 properties a month between Phoenix and Las Vegas. And, obviously all of a sudden the pandemic hit. So we use that as an opportunity to renegotiate some of our agreements. Because again, we're not buying on the market, we're buying directly from the consumer or the owner. So I'm very, very happy that we did make that decision, because what we pro forma'd out as a 8 or 9% unleveraged return on those flips, when we kind of came out of the pandemic, those turned into 15, 20, or even 25% unleveraged returns. On top of that, we're able to cherry pick some really, really good assets. So on the flip side, those who were able to capitalize and continue buying during that dip made out really, really, really well. And then on the rental side, we're pushing rents anywhere from 150 to 250 above market. There's just no rental inventory available, because we're getting in there, we're making them really, really nice. We're able to cherry pick the best tenants with the best credit profiles, significantly above market, which really helps us on the refinance side. So like I mentioned, for those who bought the dip, did really, really well, because now, as we look at today and even going 2 or 3 months back, there's just nothing available. Kind of what Daren was saying, it's a good time to flip if you could find flip inventory. Big if.
Interesting. Big if, huh? I suspect our iBuyer friends too are out there in spades, gobbling things up, making it even more difficult.
They stopped buying, right when pandemic kind of came about, and they continued to not buy for 2, 3, 4 months, and they slowly have been dipping their toes back into the marketplace, which is good for folks like us, because we're able to now compete with those owners because we're not up against the iBuyers, which has been beneficial. But now they're probably medium capacity jumping back in, and obviously they're a massive disruptor in the space.
Got it. Thanks. Russell, how about you? What are you seeing?
Definitely. So I'd second, on the asset level, I'd second what Doug was talking about with respect to surprisingly resilient occupancy. Some concerns about what credit losses look like and what's the legal impact of eviction moratoria that are potentially extended post-election. But what we're really focused on is at the institutional level. Just in the past 6 weeks, we've seen Blackstone double down with Tricon to the tune of $400 million, JP Morgan with American Homes for Rent with their build for rent venture at $700 million. And then Nuveen, one of the largest asset managers in the world, put in $400 million, Rockpoint Invitation Homes, $200 million. And then the big news this week with Progress buying out Front Yard Residential for a price that was 8% above what Amherst was going to buy Front Yard for pre-COVID. And all of those deals were just announced in the last 4 or 5 weeks. So while I do think in the near term, there are lots of questions about what asset performance is going to be like, the bigger picture that we're seeing is in the wake of COVID, you have these institutional investors that are looking for places to deploy capital, and traditional commercial real estate, dense multifamily and gateway cities aren't quite as attractive as they were just 9 months ago. But single family rentals, having been surprisingly resilient throughout all this and having the last, call it 8 years of runway to really establish itself as a legitimate institutional quality asset class, we see a lot of runway for continued capital to come into the space from the top down. What effect that's going to be, what effect it's going to have in the time to come, I think is another point of discussion, but we see a lot of strong tailwind from the big money groups coming in.
Russell, that's interesting. We're going to circle back to that point because I think it speaks to a couple of questions we had from people attending here. What do they invest in? They're looking at a lot of different things that were generating decent cap rates, decent returns. Competition is tough. We'll circle back to maybe some thoughts on where people might want to start spending their time going forward. But before we do, I want to turn over to Michael Finch to see what he and his clients are spending time on in this market here.
Yeah, we saw a lot of things happen in March, because we wear a lot of different hats here. Most of the deals we had in escrow dropped, or the deals we were negotiating dropped immediately. was, 2 months later, they all came back. Oh, can we still get that same deal? And now that had passed as the space was proving itself, as resilient as it was. To Russell's point, the amount of money that's been coming into this space, I think somewhere between 8 to 10 billion is poured into this space in the last, call it a couple months. And COVID has, really just reiterated and proven out, our thesis and what we've been saying. We come from a, development of brokerage, construction, finance, technology background under roof. And, we've always looked at the single family and now the build for rent space a lot like where multifamily was in the 80s. And we are seeing, Russell's mentioning the institutional groups coming in. SVN is the 6th largest commercial brand in the world. And we are seeing a ton of new institutional capital come into the space, whether it's family office, private equity, institutional multifamily groups. It's here to say the runway is long in our purview, and we're excited to be in it.
Thanks. So maybe touching on that, the build-to-rent, there's been a few comments on that already. Maybe starting, Mike, because I know that this kind of applies directly to what you're doing, is one of the questions is a lot of communities that are being built are gravitating towards, some of the mid to high end in terms of the price points for build to rent. The question is, so for 100,000 K plus joint income, if you will, what about rental communities built for more working class type of tenants? What are your views on those? There's a real opportunity at those price points at that level.
What we're seeing, we've consistently held what we build in our average being anywhere between 175,000 to about 240,000, which in our 6 markets gets you right in that median income where it's affordable for somebody, a household making $50,000 a year to do rent, to be able to pay the rent and to be able to live in that house. And that's what I've always done in my career of selling $1.5 billion in investment real estate in the last 18 years, is I've focused on the bread and butter. Now, occasionally we will get out of our box a little bit, like 10%, and we'll go up into that $300,000 to $400,000 range, but very seldom do we do it, just because there's such a demand for these lower priced homes from the investor side because the returns are good, as well as the renters. Your renter pool is so much greater in that space, and so we've just focused in that market and have worked hard to keep our be able to put a great product on the ground that's a 1,500 to 2,000 square foot 3-2-4-2 with a double garage on the slab, and just make it a phenomenal place to live and pull in those gross rents that you're looking for on something like that as an investor.
Got it. Thanks, Bruce. Now, how about you? You've been doing build to rent for just about as long as anybody. I mean, have you seen the market evolve, and do you think there's still as an attractive an opportunity in that space right now?
Yeah, I definitely do. That, again, the problem goes back to getting the lots or what your development costs are. So you have to build a house at a certain price for that to make sense. One thing I'm seeing, and I've always been a big believer in, is 4 and 5 bedroom houses. And so we're not doing any 3 bedroom houses because we feel with COVID, people, working out of their homes, kids maybe studying at home. If you have 2 kids in a home office, a 3 bedroom house is going to be very, very tough to live in. And so we feel our pool of tenants is much larger by doing 4 and 5 bedroom houses. And so we're exclusively doing 4 and 5 bedroom houses. And that's what we've been doing, for most of my career.
Got it. Thanks. So maybe pivoting a little bit from build to rent to more existing inventory. And Daren, this might be a question for you as we look at distressed inventory. Obviously, we're at a fraction of where we were last year. There's moratoriums in place. Do you see similar to what we saw in the last, Great Recession? Do you see a incredible amount of inventory on the distant horizon, or do you think that given all the regulation and helicopter money and all these other things at play in the market now, do you think that that potential source of inventory may not be as big as people think?
Yes, I mean, if you're expecting the inventory to look like it was in 2008, 2009, we just don't, it's hard to imagine that happening with the distressed inventory. Now, that said, I would say that there is going to be an increase in that inventory. A lot is being held back by these moratoria and by the forbearance programs that, certainly a percentage of that is going to be saved in the sense of not going to foreclosure, but there is a percentage that's going to go into foreclosure. And, there was a recent report, and this aligns with our forecast as well from Aspen Grove, looking at of the 6 million properties that have gone into forbearance, or 6 million mortgages, I should say, about 15% will end up in foreclosure, and that ends up at a 900,000 number. And that's probably, what we're expecting is 2021 is going to maybe return to 2019 levels in terms of inventory of distress. But then in 2022 is end of 2021 and early 2022 is our best guess. And again, the timing here is difficult given all of the factors you just mentioned, Ryan. But that's when we would expect the bulk of that 900,000 to start hitting is in that time frame.
Okay, that's pretty interesting to see. I mean, Jared, for guys like you have a different model, don't you, in terms of you're not necessarily going to foreclosure auctions, but you're actually going direct to homeowners to try and source inventory that way. Is that right? You want to comment on how that works out?
Yeah, absolutely. So, obviously for us to be able to control our pricing on the flip and rental side, we have to, we spend money on, different marketing strategies. We have a team of acquisition analysts here at the office who work with homeowners, try to buy the pricing that works for us and our returns. Surprisingly enough, we have not seen too much financial distress in the marketplace. A lot of the bulk inventory that we've been getting has been asset distressed or properties that are just beat up beyond repair, where they can't exit on the market because the thing is, although there are a lot more delinquencies in the marketplace, homeowners home pricing has ran up so fast here in Phoenix and Vegas. Now, all of a sudden, these homeowners have equity and they have multiple exit strategies from there. So they're not forced to fire sell these or have their house go to the auction. So there's a lot more exits for these homeowners where they don't have to sell at a discount. But what we are seeing is a lot of beat up houses come through over more of like the financial side distress. Got
it. Helpful. I'm going to hit pause real quick. I think we got a survey question. Now, here we go. In 2021, I plan to invest in fix and flips, existing single family rentals, build for rent, multifamily, and then other. All right, that's pretty interesting. Existing single family rentals got the majority just barely, and it looks like pretty well represented by a number of other strategies here. So Douglas, you've been doing single family rental for a while, and obviously built a very attractive, well-performing portfolio. A lot of money coming in the space. As kind of an owner operator, how do you look at that? Are you kind of charting the same course that you always have, or do you see opportunities to go someplace sunny, more tropical, and move on, or are you going to kind of double down? What do you think makes the most sense for guys like you?
Man, that's a great question. because when we started this, we like to think, and still like to think, we'd zig when other people zag. So, when Russell gets on here talking about, and Michael, hundreds of millions and billions of dollars flowing into this space, that, there's one part of ego that you love to be like, hey, yeah, man, aren't I smart? Didn't I pick the right asset class? But then there's the other part of you that's like, hey, this is kind of a big boys game. It's just different. It's run up the prices, it's just not like it was 20 years ago. So yeah, it makes you think, but it also, I think this is a really big space, man, and we're really early in the game. So there's room for everybody. Even if you want to buy a duplex, live in one side and rent it out, you can house hack and do that. Or if you want to build a 80, 100,000, unit portfolio, you can do that. So personally, and what again, we work with individual investors, folks who are trying to build for retirement or to kind of create financial freedom or kind of get some passive excess income for them. So they're still anxious and excited about it, and they're flocking in droves right now, just because people see the stock market's volatile. They see bond market with rates, hovering near zero. So they like that real asset that they can see, touch, feel, that's got a good return and is less volatile. So to answer your question, we're sticking with the tried and true and just trying to find opportunities and looking at this as a long game. Most individual folks are long game, and some of them are doing what is the mutual fund industry, kind of coined it years ago, the dollar cost averaging. So, hey, you buy a couple this year, you buy a couple next year, maybe you overpay 1 year, maybe you get a real big discount the next year. So just keep adding to your portfolio over time. So that's kind of the model. And then pruning selectively when opportunities present themselves, like right now. So that's kind of how I'd answer that.
Got it. And
I can jump in there, Ryan, and
yeah,
I think
please.
Douglas made a good point, because Russell and I have talked about the big money coming into the space, which absolutely shouldn't frighten any small investors, because to Douglas's point, the space is so big, and that big money that's coming in should give the smaller investors the confidence to know that they're entering the right space, because that big money doesn't come in unless they believe in it. And, the space has been proven by the small guys for the last 30 years anyways. So, if you get in, there's no bad time to get in. To Douglas's point, again, you can buy, hopefully you're always buying right. But if you do overpay and you're in it for the long game, prices go up and down in the short term, but they tend to go up in the long term. And, it's about cash flow and creating assets in your portfolio that will always be needed, and that's a truth, the single family. So I wanted to mention that, just to not scare anybody thinking that you can't compete because Blackstone's coming in and Tricon and Amherst and all these guys are dropping billions. It merely proves that it's an asset class that's here to stay, and there's opportunity everywhere. Small markets, secondary markets, primary markets.
Right.
Everybody needs a home.
Got it. No, I did notice everybody, sat up a little bit straighter when Russell started dropping the names that were getting into space and how much they were spending. Russell, question for you: with the new, some of the new investment in the space, you're dealing with a lot of investors, capital sources looking to come in. Are they looking at primary markets, secondary markets, tertiary markets? Are there any themes that are kind of coming out of your discussions that people should be aware of?
I think we're seeing, in terms of markets, the traditional, call it smile states, North Carolina to Texas, and then Arizona, Nevada, Colorado. But we are seeing to see a little bit more flexibility in the institutional buy box, where going back 5 years, it was the typical Class A asset that was a 3-2, good schools, 1990 year built. And now we are seeing, as new capital comes in, they're willing to go down to the 3-1, 1950. Of course, if the yield makes sense for them and is mitigating that additional risk. But I think as the if you were to go back 5-6 years, that institutional capital could afford to be super picky because there were a ton of assets. But now that things are getting so competitive and that these platforms have demonstrated their ability to manage portfolios of 20, 30,000 assets, it makes it a lot easier for them to, again, widen things a little bit, buy an older asset, buy a little further outside of town than they're used to. So I think that's one of the exciting developments. And looping back to the last question of what, the smaller investor that got in 2012 and made a great trade, what do they do next? I do think that, that institutional capital will never be able to outcompete guys like Jared and Douglas, right? Who know their market and are going direct to a consumer, are able to close quickly. And so I do think we're seeing the non-institutional guys either double down, making sure their operations are in place and good to go, and that they are, they're solid on their market. And then also we're seeing some folks try to get ahead of the institutional curve, right? So they're not buying in Atlanta anymore, which is the most institutionalized city. They're moving to a Chattanooga or a Birmingham or a Jackson, Mississippi, right? Places where you can see the underlying demographics point in the right direction, but institutional capital isn't quite there yet.
Got it. And so, Mike, maybe McMullen, a question for you. I know Alabama initially kind of, was skipped over by some of the bigger institutions. Obviously, places like Birmingham and Huntsville are pretty interesting markets for a lot of different reasons. So what are you seeing in terms of, more competition coming your way?
We're seeing, of course, we're still working with our, Douglas, we're working with our individual buyers a lot that we've worked with for years, but we are seeing a lot more activity in that institutional space, and especially in the last 18 months, and it's really ramped up in the last 4. And like Russell said, it's one of those things. We've specialized in these tertiary markets where we're, Birmingham, Huntsville, Tuscaloosa, and Jackson, Mississippi. I mean, Jackson, Mississippi's numbers are phenomenal for the investor. It was shocking to me whenever we decided to go into that market, that the returns you can get for what you build over there as an investor. Same thing on the coast of Mississippi and the coast of Alabama. You've got, I think everyone has said we've got a long runway with this thing. It is, we're in the infancy. And fortunately for those of us who have been in this I've been doing build to rent for 17 years, having all the systems already in place has been the key. And for anybody who's watching this, who's investing in the market, you want to get with people who have been doing this and understand it, because there are a lot of things that you can get caught up in that cost you money if you're not working with the right people. And I would suggest, anybody on this panel is a great person to contact if you've got questions in this space.
Great, thanks. We're going to pause 1 second. I think we have another survey. We do. Okay, so 2021 outlook from the real estate market. Is it going to be on fire? It's going to be better? It's going to be unchanged, worse, or ice cold? Have a sense it's going to be on fire. Better. Okay, I guess it's on fire now, so better is kind of counts, but it's definitely much more positivity in the market, which is great to see. Daren, what are the factors that you think, this panel, people on the phone, maybe some key indicators people ought to be aware of as we kind of navigate the next several quarters? There's obviously a lot going on between this thing called the election, in terms of the COVID virus, just in terms of some of these programs that the government has put in place, or kind of question marks around those. What are some early warning signs or things that you think we ought to be paying attention to?
Yeah, I think to kind of tie into that poll question, I do think that the on fire state of the real estate market right now is somewhat been, not to be the Debbie Downer on the panel, but it's been propped up by a lot of the government intervention, both on the stimulus side as well as the forbearance side when it comes to foreclosures. That's holding back some of that distress. And I expect at some point, and it may be 2021, probably 2021, we're going to see some of that pulled back. And now the housing market was doing fine before the pandemic, and so it's not like it's going to collapse like a house of cards. I wouldn't expect, but will be a little bit of a realization that what we're in right now is a little bit of a sugar high, and we're probably going to come off that a little bit, would be my opinion. And the warning signs, to answer your question, to look for that would be the early warning signs would be when, at least on the distress side, when we start to see that those foreclosure numbers that I was showing on that heat map get closer to 100% of pre-pandemic levels or exceed 100%. And that probably won't happen until the moratorium is lifted, but that's certainly a sign that more distress is entering the marketplace, which could put down some downward pressure on home prices. And so that would be one of the first things I'm for sure looking at. And then supply from, I didn't touch on supply from the retail market, but that's also been somewhat pulled back by sellers who are a little bit scared, uncertain to sell. And so you see that inventory. So if you see that inventory number coming up as well, the retail inventory, where supply is starting to increase and put some downward pressure on prices, that's another key indicator that I'm keeping an eye on.
Got it. Thanks. Maybe we'll go quickly around the horn. I know we're getting somewhat tight on time, but there's been a few questions coming through just on return expectations, cap rates. So maybe Michael, starting with you, what are you seeing in terms of the deals you're looking at, talking to your customers about?
Again, it depends on, primary, secondary, and tertiary markets, but, we are seeing a lot of, mid fives, high fives in the primary markets on cap rate acquisitions. If you get into, the secondary and tertiary markets, you can start moving into the sixes. We've sold, some stuff in the low sevens in some tertiary, but strong tertiary markets. Mm-hmm. And I'm talking about net cap rate. A lot of people in the industry talk about gross caps, but I'm talking about a net cap rate here, on those acquisitions. But you can find high fives to low sevens, and real caps on NOI in markets all over the country.
Got it. Douglas, what do you think about a rental portfolio these days? How do you think returns are looking?
Yeah, I think that kind of what Michael said, we see people still looking for over 15 if they can find it, but 6 to 8 net is in that range. We've seen a lot of people, compressing. It used to be that 1% ratio that people would use, the individual investors, and they've gotten more aggressive and lowered that to about 0.85, so somewhere in that range, but just to get in the space. So.
Got it. And Jared, how about you?
So we don't sell any of our rentals, and I'm not buying rentals, on the market or through brokers. But I could speak on, the way we buy and the way we push rents. We have an aggregated net cap rate of anywhere from probably about 6 3/4 in Phoenix and Vegas. And I'm talking like your Class A locations, Chandler, Gilbert, Mesa. We do have a couple in kind of your B areas that kind of balance out the portfolio a little bit, so we could hit the SCR for the refi, but strong caps with our strategy at least.
Got it. And Bruce and Mike, maybe starting with Bruce, how do you think returns are looking on the build to rent side at this point?
So I think the one thing that's really helping is the cost of capital. And I think that's been a big thing for us, as we can afford to expand and do some things. Although it's more expensive to do it, our cost of capital is low. And so our business continues to grow basically because how cheap the cost of capital is right now.
Right. We're doing our best, by the way. We're doing our best on that. So we'll keep working at it.
Can I get another half point, right? No.
That's an offline conversation, by the way.
Yeah.
So Mike, how about you?
What we're seeing, because we pretty much 95% everything we do is the build to rent space. And what we're seeing is high fives to mid sixes on new homes. And it's really consistent across all of our markets. One of the things that's interesting, I'm kind of diverting from this because it popped into my head, is our collections rate. When Douglas was saying this, we have had incredibly high collection rates since March, to the tune of like 99.2 to 99.4% on 1,700 properties, which is better than our pre-COVID collection rates, which is a very interesting thing. And what we're seeing are people coming into our market from where the lockdowns are severely extreme. We're seeing anybody who can telecommute, we're seeing a flood of people moving in that we have never seen before. And that's happened a lot in the last 4 months. And I think that's a dynamic that's going to play into the values across the country. And I think it's going to be segmented as far as where there's going to be foreclosures available and not available, in my opinion.
Yeah, that's a good point. I know we're very tight on time here. Russell, just, quickly, maybe the new money coming into the space, guys you're talking to, what are they looking to achieve in terms of net returns here? Maybe on a levered basis.
Yep. On a net cap, it's, call it a 5 to a 6.25, 5 being your class A in Atlanta, 6.25 being that secondary and tertiary. But as Bruce mentioned, the cost of capital that they have, the cheap debt, enables that 5 to turn into a net levered IRR in the low to mid teens. That seems to be the bogey that most people are trying to hit.
Okay. We have one more quick survey question and then just a couple parting comments. We want to be topical here, so we want to get the experts to opine on the presidential election. The winner will be either Donald Trump, Joe Biden, Kanye West, or maybe a write-in. Let's see what the crowd says. Didn't take much for Kanye to get on our ballot, apparently. Okay, interesting. You heard it here first, everybody. That is going to take us actually a little bit through our planned time here. A couple things just as we depart. First off, I want to thank all the panelists. An amazing job, everybody. Thanks for spending time out of your busy day, answering questions, providing some insights into your day-to-day activities. I think that's hugely helpful to everybody that's joined here. So thank you for that. For people that submitted questions that we didn't get a chance to address, we will do so. We typically carve these out to the various panel members, and we answer those offline, and then we'll get back to you, say, within the next few days once we have an opportunity to combine and pool everybody's answers. So stay tuned, and thanks to the audience again for joining us. I know everybody's busy. We'll look to do another one of these in the next few weeks, so any topics that are of interest, please send them in and we'll try our best to accommodate. But thanks, everybody.
CoreVest is the leading lender to residential real estate investors. For more information about our long-term rental loans or short-term bridge loans, visit CoreVestFinance.com.